I'm sure you've heard the news. Bond yields are climbing again, and everyone's watching. This isn't just a blip on the radar. It's a significant move that's catching the attention of investors, analysts, and policymakers around the globe. The rise in yields is sending ripples through financial markets, impacting everything from mortgage rates to the cost of corporate borrowing. It's a development that's hard to ignore, and it's prompting a lot of questions about what's really going on beneath the surface. But what's really driving this move? Let's break it down. There's a complex web of factors at play, and understanding them is key to making sense of the current market environment. It's not just about one headline or one economic report. It's about the interplay of global forces, policy decisions, and investor sentiment. So let's dig a little deeper and see what's fueling this surge in bond yields. Previously, we flagged a likely rise in US bond yields, and that call's looking stronger by the day. The data has been pointing in this direction for a while, and now the market is catching up. Investors are recalibrating their expectations, and the upward trend in yields is becoming more pronounced. This isn't just a US story either. It's part of a broader global shift that's affecting bond markets everywhere. Why? Because three of the world's major central banks, the US Fed, Bank of Japan, and Reserve Bank of India, have all made it clear, no more rate cuts for now. In fact, some are even hinting at the possibility of future hikes if inflation doesn't cool off. This unified stance is sending a strong message to markets that easy money is off the table, at least for the foreseeable future. Central banks are prioritizing inflation control over growth, and that's a big deal for bond markets. Add in the ongoing Iran-Israel tensions, and inflation expectations are creeping up. Geopolitical risks are always a wild card, and right now they're adding fuel to the fire. Higher oil prices, supply chain disruptions, and uncertainty about the future are all contributing to a more inflationary environment. When investors see these risks piling up, they demand higher yields to compensate for the added uncertainty. That means there's very little room for central banks to loosen policy, even if markets want it. The pressure is on to keep inflation in check, and that means higher rates for longer. Investors hoping for a quick pivot to easier money are likely to be disappointed. But that's not all. There are other forces at work that could keep yields elevated. The US is starting to see rising unemployment. Jobless claims are ticking up, and some sectors are feeling the pinch more than others. This is a worrying sign, because it suggests that the economy is losing momentum even as inflation remains stubbornly high. It's a tricky situation for policymakers, who have to balance the risks of slowing growth with the need to keep prices under control. When you get higher inflation and higher unemployment together, you get stagflation, a scenario where bond yields tend to jump, not fall. Stagflation is a tough nut to crack, because it limits the options for central banks. Cutting rates could stoke inflation, while raising them could worsen unemployment,